Ever feel like too much of your paycheck disappears to taxes and doctor bills? What if I told you there's a way to keep more of that money in your pocket, totally legal and super simple? Meet HSA and FSA. They help you cover things like prescriptions, co-pays, and other medical costs without paying taxes on that money. But while they seem similar, they work very differently. In this video, I'll break down the key differences between HSA and FSA in plain language, covering eligibility, contribution limits, when and how to use them, investment options, and tax strategies, so that by the end of this video, you will know exactly which account is the right fit for you and how to make the most out of it. Let's dive in. So first of all, what they are. HSA stands for Health Savings Account. FSA stands for Flexible Spending Account, which actually includes a few subtypes: Healthcare FSA, Dependent Care FSA, and Limited Purpose FSA. In this video, we'll mainly focus on healthcare FSAs, but I will also briefly touch on other types of FSAs when relevant. HSAs and FSAs have some important differences. First, in terms of eligibility, FSAs are employer-sponsored. You can only get one through your employer's benefits program. If your employer doesn't offer an FSA, unfortunately, you're out of luck. But there's also good news. FSAs are independent of your health insurance, so even if you're on your spouse or on your parents' health plan, you can still enroll in your employer's FSA as long as your employer offers one. For HSA, to be eligible, you must be enrolled in a qualified high-deductible health plan, which is also referred to as HDHP. This can be through your employer or purchased independently, like from the marketplace if you're self-employed or if your employer does not offer one. But how to tell if a plan is a high-deductible plan? For 2025, the IRS defines a qualified high-deductible plan as a plan with a deductible of at least $1,650 for individuals or $3,300 for families, and a max out-of-pocket limit of $8,300 for individuals or $16,300 for families. These numbers change annually, so make sure to double-check before enrolling. What about contribution limits? In 2025, the IRS sets the max contributions to FSA at $3,300, but your employer might set a lower limit. You choose your amount at the start of the benefit year, and typically you cannot change it unless you experience a qualifying life event like marriage, birth, or job change. FSA contributions are deducted from your paycheck in equal installment. Let's say you elect $2,600 and get paid bi-weekly. Your employer will withhold $100 per paycheck across 26 pay periods. For HSA, we see a more flexible contribution schedule and higher limits. In 2025, HSA contribution limits are up to $4,300 for individuals and up to $8,550 for families. Plus, if you're 55 or older, you can contribute an extra $1,000 called a catch-up contribution. Unlike FSA, you can adjust your HSA contributions anytime during the year, and you have until tax day, which is usually April 15th of the following year, to make contributions for the current tax year. So if you're not sure how much to contribute, you can wait until April of the following year and decide based on your actual medical expenses. This flexibility is a major perk compared to FSAs. Both you and your employer can contribute to either account. But remember, the total contributions cannot exceed the IRS limit. For example, if your employer contributes $2,000 to your HSAs, because the cap is $4,300 in 2025, you can only contribute $2,300 more as an individual. The next difference between these two accounts is when you can use the funds. For FSA, you can use your full annual election amount on day one of your plan year, even though you are paying it off via paycheck deductions. For example, if you elected $2,000 for a year, you can spend the full $2,000 upfront, even if you've only contributed $0 so far. And if you leave your job before the year ends, you may not need to have to repay the difference, even if you've already spent more than what you've contributed. But here's the catch. FSAs are use it or lose it. If you do not spend all of your FSA funds by the year ends, the leftover amount may be forfeited. Some employers may let you carry over up to $660 into the next year, but that's totally up to them. Also, when you leave your job, your FSA does not go with you. You lose access to it. With HSA, it's the opposite. You can only use the money that's already in your account. So, say if you have $800, that's all you can spend, no front loading. But your HSA account is yours. Even if you leave your job, you do not lose the money. And while you cannot contribute without an HDHP, you can still use existing funds at any time for qualified medical expenses. Okay, now we'll talk about the fun part, investment options. This is what I personally believe is the biggest difference between these two accounts. For FSA, there's no investment capabilities. It's basically a tax-advantaged checking account for health expenses. The money just sits there in your account until you spend it. With HSA, here's where it gets exciting. You can invest your HSA funds just like a retirement account. Depending on the HSA provider, which is a company that holds and manages your money, you can invest in stocks, ETFs, mutual funds, and more. Some HSA providers require a cash minimum, like $1,000 or $2,000 in your checking balance before you can invest the rest. Others, like Fidelity, have no cash minimums and charge zero fees for investing. This video is not sponsored by Fidelity, but personally, I love Fidelity's HSA accounts because it charges $0 maintenance fees, $0 self-directed investment fees, and there's no cash balance requirements. That said, if your employer provides the HSA, they will usually partner with a specific provider. If you don't like their cash balance requirements or fees or think their investment options are too limited, you might consider transferring your funds to another provider. But just to make sure not to close the employer-linked account while you are still employed with them, because it may affect ongoing contributions from either you or your employer. So that brings us to the last difference between these two accounts, which is about tax advantage. Any contributions made to your FSA account reduces your taxable income for that year. That's pretty good, right? You don't pay tax for money going into your FSA account. But that's it. There's no investment or tax-free growth benefits. HSA, on the other hand, offers triple tax advantage. This is where HSAs shine. Triple tax advantage refers to, first, tax-free in. Your contributions lower your taxable income for that year. Second, tax-free growth. Investment gains are not taxed. Third, tax-free out. Withdrawals for qualified medical expenses are also tax-free. This makes HSAs more tax efficient than even 401ks or IRAs. For example, if you contribute $3,000 a year to an HSA and invest it with an average 7% return for 30 years, you will end up with over $300,000, completely tax-free if used for qualified medical expenses. If you just kept that money in cash, you would have $90,000. That's still great, but investing gives you an over 3x difference and is not taxed. With such great tax advantages, it seems like a no-brainer to treat an HSA as an investment account. But in reality, only about 1 in 6 adults in the US have an HSA, and of those, only 10 to 20% are actually investing their HSA funds. One reason may be that people assume they need to keep the money liquid to cover medical expenses as they arise, so they avoid investing it. But here's something many people do not realize. If you pay for qualified medical expenses out of pocket and save the receipt, you can reimburse yourself years, even decades later, allowing your HSA investment to grow tax-free in the meantime. That's right. According to the IRS, there's no time limit for reimbursing yourself as long as the expense occurred after you opened your HSA. You just can't reimburse for anything incurred before the account was established. Here's an example. If you contribute $3,000 to your HSA annually and use $2,000 of that for medical expenses each year, investing the remaining $1,000, you would end up with about $100,000 after 30 years, assuming a 7% average annual return. But if you paid the full $2,000 out of pocket each year and invested the entire $3,000, your account could end up growing to approximately $303,000. Even after reimbursing yourself $60,000, which is the total amount of those out-of-pocket expenses over the 30 years, you will still have about $243,000 remaining in the account. And once you turn age 65, you can use your HSA money for anything, not just medical expenses, without penalty, though non-medical use will still be taxed. But if you used it for qualified medical expenses, withdrawals remain tax and penalty-free. So if you are able to cover healthcare costs upfront and hang on to your receipts, letting your HSA funds grow untouched could be one of the smartest financial moves you can make. However, if you need to rely on those funds in the short term, investing everything might not be ideal given the market's ups and downs. Now that we've covered a lot about FSA and HSA, can you have both accounts at the same time? Generally, no. I learned this the hard way a few years ago. I thought I could use my HSA as a long-term investment account for future health expenses and my FSA for reimbursing current year medical expenses. But when I submitted my medical reimbursements, I discovered that my FSA had automatically been converted into a limited purpose FSA, meaning I could only use it for dental and vision expenses, not general medical costs. So don't make the same mistake I did. If you do plan to enroll in both an HSA and a limited purpose FSA, be aware of the rules and plan your contributions carefully. So which one should you choose, HSA or FSA? Well, if you're already enrolled in a high-deductible plan, then choosing an HSA is a no-brainer. It's the only account that offers triple tax advantages. If you are not on a HDHP and you're considering switching just to access an HSA, here are a few things to consider. First, check whether your employer contributes to your HSA. Many do, and I've seen contributions range from $600 to $3,000 per year. This can make switching to an HDHP much more worthwhile. Second, consider your expected medical expenses. HDHPs come with higher out-of-pocket costs, so if you have young kids or dependents who need regular care, it might not be the best fit. But if you're young, healthy, single, and rarely visit a doctor, and especially if your employer contributes to your HSA, then switching to a high-deductible plan and opening an HSA could be a financially smart move. Remember, FSAs are still great for tax savings if you're not eligible for an HSA. But if you can get an HSA, and especially if you can let the money grow, it has far more long-term advantages. Whichever account you choose, don't leave tax savings on the table. Be intentional, invest if you can, and use these tools to your advantage. If you found this video helpful, please give it a like and subscribe for more content on personal finance, smart money moves, personal growth, and career development. If you have questions about HSAs or FSAs, drop them in the comments. I would love to hear from you. See you in my next video.